Welcome back to Building Wealth Through Strategic Real Estate with Ryan Norris, the podcast dedicated to helping you scale your property business and make smarter investment decisions. Ryan, it's fantastic to finally have you on the show. I have really been looking forward to this conversation, especially after our pre call. How are you doing today?
Well, first off, thank you. I'm honored that you reached out to me and thought I'd be a good fit on your podcast. So I would say I'm doing fantastically well. Thank you.
Excellent. Just to let our listeners know, this is a live recording and we will take between 30 to 40 minutes. Are you comfortable with this?
Of course.
Fantastic. Today we are going to unpack Ryan's unique approach to building generational wealth through real estate, covering everything from navigating the US market to managing a massive portfolio. Ryan brings an inspiring journey from starting with no money or experience to successfully managing 87 communities with $250 million in assets under management. He's a true advocate for strategic growth, empathy in client management, and a relentless drive to improve. By the end of this episode, you will have actionable insight to refine your own investment strategy. Ryan, it's great to have you here. We had a great pre-call, and I'm really excited to dive into our topic today, building wealth through strategic real estate. For our listeners, let's start by setting the stage. From your perspective, what are most significant trends or shifts you are currently observing in strategic real estate growth and capital markets, especially concerning the challenges of inflation, market overvaluation, and the need for stable returns?
First off, this is a great question. I wanted to quickly just provide context to your listeners. So when I started, I had no money, no network, and no experience. And I had to learn myself from the front lines. I had to go and live in a mobile home, pay myself the property management salary, which was less than half of what I was getting paid to work at a bank. I had no health insurance, which in the United States of America is a problem, like over in the UK, in Europe. And I figured it out. And I made massive sacrifices. I taught myself Spanish. I taught myself accounting. I taught myself computer programming. And those frontline skills ended up making me a much more well-rounded investor as well as owner operator. And so to answer your question, now that we have a little bit more context there, right now, times are weird because we're in some uncharted territory. And we as human beings prefer certainty. We as human beings like mathematics that resemble more of engineering and less of statistics. And what I mean by that is when we go and underwrite some type of financial instrument, be it a real estate, cash flowing property, or even a stock or a bond, when we underwrite that and we get an IRR or multiple on capital or whatever financial metric you are looking to solve for, we want a very precise answer. And I'm sorry, but underwriting and guessing the future is always going to come with some statistical bias. And the more we spend time in our underwriting models, the more we believe we are correct, which is even more dangerous. And we look to history because we believe history repeats itself. Well, history doesn't repeat itself. History, it rhymes. What goes around comes around. But AI has never existed in the history of humanity that we know of. And that throws a lot of fog, shade, uncertainty around our financial models. And it's interesting reading macroeconomic theory right now. Some people project a non-zero chance that we all go extinct and the robots kill us. Some people project the exact opposite, that things are so great that half of the population doesn't need to work. and we can focus on whatever it is we want to focus on. Me personally, being in the philosophy that history doesn't repeat itself, history rhymes, I am looking at the dot-com bubble of the early 2000s as my historical probably is going to be similar towards what's happening in the near-term future. I do firmly believe AI is going to change everybody's lives. It's already doing it. Do I think that in 6 months, if anybody here is a fan of the Terminator, I think Skynet is going to go live and nuke everybody? Probably not. Maybe it's a non-zero, but I don't think so. I think what's much more likely to happen is the same thing that happened with the internet, which is at first it was a weird thing that no one really understood and everybody thought was weird. And then people started using it. And then when grandma starts using it, you're like, okay, maybe we have something here. And then it gets overvalued. And then there's a bubble and then there's a correction. But flash forward, if you want to say the internet really started getting popular in 1995, flash forward 31 years later, and we are literally conducting this over the internet. So to me, that's AI. AI is going to follow a similar path. It's going to have a bubble. People overhyped it in the short run, and in the long run, it far exceeded anybody's expectations. And you have to kind of, as an investor, pick your lane, because you can't always get it right. And even if you get it right, you're going to miss to a certain degree. But you can't not make a guess because you have to press forward. And so when you look at today's climate, you have higher interest rates than the last 10 plus years, because after the 2008 crisis, for about a decade, interest rates were effectively zero. And while interest rates today are more in line with historical averages, having been at it for 10 years with basically free debt, it's just impossible for someone like me who graduated undergrad in 2009 and who only knows how to operate in real estate with effectively zero interest on your debt. Liquidity is totally different, and money markets and treasuries and bonds were basically zero. And so therefore everybody was throwing money at anything that could pay you more than like 1 or 2%, right? And so in today's marketplace, historically, it should be behaving a lot more normally because interest rates are plus or minus your historical norm. But we've got a lot of factors that throw a lot of weird uncertainty, right? So higher interest rates mean lower transaction volume by design. You have, our government, God bless them, love them or hate them, they're not behaving consistently, and it's very difficult. Investors don't like inconsistency. So are we going to attack Cuba? We just decided we are going to attack, we did attack Venezuela and Iran. I didn't see that coming. I don't think anyone saw that coming. The Strait of Hormuz, apologies for mispronouncing that. I did not see that coming at the beginning of the year. Now, gas prices are way up, which is huge in the United States of America, because we're so big geographically that we require gasoline, or petrol as they call it. Apologies, y'all. As you would say in England, you use proper English and we speak American English. So
Yeah.
apologies if some of the terminology I use isn't used across the pond, so to speak. There's a lot of factors that do not make our economy look good in the short run. But let me just finish answering your question by saying it doesn't matter. None of this matters. And here's why it doesn't matter. Because if you fundamentally understand your asset class, you know how to operate, you know how to buy right, you know how to operate correctly, and you're not reckless or speculative or buying for the wrong reasons. There are plenty of people who bought things in 2007 that did fantastically well throughout the Great Recession. There are people who bought things in the middle of COVID who did fantastically well throughout the interest rates rising. And, it's just like over here in the United States of America, we'll have hurricanes and tornadoes. And what is just kind of funny, if you've ever been through a hurricane or a tornado, is the news will get videos of just devastation. So I own in Asheville, North Carolina, and you may have heard that the Hurricane Helene randomly hit the mountains of North Carolina, which is no one would have guessed a hurricane could have got that far inland. And it just absolutely decimated probably a quarter or so of the city. And my properties were largely untouched. Why? Because they were built correctly. They were not in flood zones. They didn't have a lot of trees that would fall down and cause a lot of damage. They had proper irrigation. They were just built right, and they were purchased correctly. So now, I'm not saying we didn't spend money. We did. We spent tens of thousands of dollars, but I was in the majority of people that own property in Asheville. And the folks who took shortcuts or bought in the wrong place at the wrong time and maybe even didn't buy incorrectly, they just got unlucky. It's the same thing. The news isn't going to show you the 75% of the city that's just fine and is going back to work the next day, right? The city's going to go and show all the devastation. And so when you look at, the 2008 crisis and you go, what is the news going to do? It's going to go and show you the devastation. It's not going to show you all the businesses that were fine. So as it turns out, if you go and learn and you don't outsource and take shortcuts, you learn first and outsource later. If you go and you truly become a great owner, operator, investor, and you make good judgment calls, it almost doesn't matter as long as Terminator doesn't come and show up and end humanity. You can buy right in good times and bad and be just fine.
That is a really insightful overview. You shared your remarkable journey from 2015, starting with no money, network, or experience to become a successful real estate entrepreneur managing 87 communities and $250 million in assets. You described how you live on site as a property manager and reinvested all earnings. Can you expand on what inspired this uh, relentless drive and how you managed to scale your portfolio so significantly over 11 years?
Yeah, absolutely. So I had more student loan debt than I had cash. I was living maybe a little bit better than paycheck to paycheck, but I didn't have any money. And when you invest, there's really kind of two lanes you can take. You can preserve your capital, or you can try to multiply your capital. Obviously, multiplication is a lot riskier, but when you don't have any money, what's there to preserve? You have to multiply it. And from there, the decision is, do I want to stay small and have a bigger piece of a smaller pie? Or do I want to have a smaller piece of a larger pie? Going on 11 years ago, what I had decided to do was have a smaller piece of a larger pie. So when you hear $250 million worth of assets under management, that doesn't mean I'm worth anywhere close to $250 million. First off, there's a lot of debt. So there's, 9 figures worth of debt on that. Then I am a super minority of a much larger investor pool. So I'm not someone who's worth a cajillion dollars, right? I've opted instead to build a team of 30 plus people, learn the skills, and eventually exit so I can start over on my own. So my long-term goal is actually to own myself and not have to deal with rich people who come with rich people problems. God bless them. They're mostly wonderful human beings that I'm very proud to have served, but there's always going to be someone who's just annoying, or their head is in the wrong place, or they're in it for the wrong reasons, or it's not a good fit. And it's frustrating having to deal with other people's money. However, I didn't have a choice. And if I'm being quite frank, you get farther together than you ever will alone. We human beings evolved and grew in small little tribes and clans. We had families. You had your nuclear families is a relatively new concept. Generally speaking, over the millennia that we evolved, we had all of our family and all of our friends and all of our coworkers all living in kind of tight quarters until we ended up starting farming, and then eventually you have, post World War II, where manufacturing happens in the United States of America, and then you buy a house and it's, husband, wife, and kids, and then you drive to your in-laws, and then all of a sudden now we're living in different cities, states, etc. That's a relatively speaking newer concept. So when you kind of look at life from that perspective, in terms of evolution, scientific, adaptation, if you will, eh, we're all designed to work together. It's frustrating watching the news and getting really angry at people who disagree with you, or people who are, in the same country as you, and you think they're the enemy. And we as human beings kind of do need an enemy. And when you don't have an enemy, you kind of turn against your brethren, if you will. But the reality is, we will always get further together than we will alone.
Yeah.
And so, although I chose a path, I didn't choose a path. I had no choice. I had to force using other people's money because I didn't have any. Now that I'll hopefully have the chance to go it alone, I probably still won't, because my mantra in life is that I want to make the world a better place because I was in it and I existed. And that's how I was raised, and that's how I would like to live my life. I want to make other people's lives better. My life will be just fine. People will come and help me when I need help, but I want to live to serve others. I don't need money. I want to have enough money that I'm comfortable, but beyond that, like, I don't need fancy things, and I don't want it. It doesn't bring me happiness. Helping others brings me happiness. So to me, going off alone doesn't really make any sense, because I would get farther with someone else or a group of people, and I would be helping others and others would be helping me. And again, that all comes back to who we are biologically designed to be, which is part of a tribe. And we help one another and we take care of one another. And sometimes you help someone, and the other time when you need help, you get help. And that, to me, is the meaning and purpose behind life, is helping and serving others.
It's clear that your hands-on approach and dedication are key. You also highlighted the challenges of competing with large private equity firms in your asset class. What strategies do you employ to anticipate market changes years in advance, consistently adopt and maintain a competitive edge as a smaller legal operator against these larger players?
It's a great question. And I'm glad you asked that, because I want to share a very obvious answer, which is, it's David versus Goliath. The private equity shops are Goliath. They are going to have more money than you. They're going to have a bigger team than you, more resources, more educated people working for them. They were going to win if you try to compete conventionally. They will outbid you, all of the above. But you know what they won't do? They won't be on site serving as a property manager, living in a mobile home, sleeping on a blow up mattress, teaching themselves a foreign language, learning computer programming. They are not going to be on the front lines. They're just not. Now, they're going to hire someone to be on the front lines, but do you think they're going to listen to that person? I mean, maybe, but when you have a principal within your organization, a co-owner or the owner living on site, being on the front lines, going to the local restaurants, the local gas stations, talking to the local politicians, the residents, etc., there are insights that you will gain when you are on site. Here we have a visitor. There are insights that you'll gain. Say hi.
Hello,
Hi.
hello,
Say bye-bye.
sweetie. She's so
There
cute.
Thank you. There are insights that you will gain by being on site in your town, learning about where the city came from, where it's at today, and where it's going in the future. Because not everything is on the internet. And when you go to your town and you go to city council meetings and the local community meetings, and you get to learn and meet the people that drive the town. There is so much that you will learn that is just not on the internet. And in the United States of America, trading equities, stocks with information the market does not have access to, that is called insider trading. That is illegal. But in private real estate transactions, insider trading, where you have information the market does not have, is not illegal. What is insider information in real estate? It's taking the time to go to your property, to talk to your residents, to talk to folks that are movers and shakers and important people within the town, talking to the businesses, understanding that market. And when you are doing that and you get insider information, if you will, you all of a sudden are smarter than the private equity shops. I don't care how many MBA graduates they have. I don't care how much money they throw at it. If you are there yourself and you are learning these insights, you will have a competitive advantage. It's information asymmetry and you will win. And not only that, big institutions, they don't go after every single asset. You can go and buy small, troubled, lower quality assets in locations that may not necessarily be ideal. And you can craft some really interesting strategies that private equity won't touch. And here's the fun part. They may not touch it today, but you might have insider information that there's a property that will be institutional one day, that will be bought up by a private equity shop, but they don't realize they want it yet. And you can get it first. And that is the real magic of being David against Goliath.
This is incredibly valuable for long-term strategic planning. Now let's address client management challenges. You operate in an asset serving clients, residents with limited credit, income, and experience. You emphasize the importance of understanding these clients and using empathy while maintaining firm management. How do you balance this approach to maintain a safe and clean environment for residents while ensuring investors' expectations for stable returns are met?
You got to be firm but friendly. So I'll say that again. You have to be firm but
But
friendly. And what that means is, you're just like my daughter, even though I locked my door, she came right in. It doesn't mean I don't love her when I tell her she can't have chocolate for breakfast. She's going to get mad and start crying and melting down. But I'm sorry, sweetheart. It doesn't mean daddy doesn't love you. It doesn't mean daddy's not going to change your diaper. It doesn't mean daddy's not going to lose sleep when you wake up in the middle and someone to rock you back to sleep. Doesn't mean daddy's not going to do all those things. He's not going to love you. He's not going to serve you. It just means you can't have chocolate for breakfast. I'm sorry, but I have to draw the line somewhere. And I'm not going to bend on this, no matter how much you scream, yell, shout, cry. The reality is, I would love to house everybody. But some folks, they just make bad decisions. They shoot off guns. They bring in dangerous dogs and pets and animals that shouldn't be there. They do things like deliberately not pay you rent. They do some things that you can't have in your communities. And look, I mean, you have to have the conversation up front. You don't have to be rude. In fact, it's better to be direct when somebody does something that you can't tolerate. But you should also listen. And just because I listened and our team listened to you doesn't mean I'm going to let you shoot at your neighbor's house. You can't do that. You can't shoot up heroin in the street. Like, I'm sorry, you can't do that. You have to go. It's heartbreaking to lose someone. And I don't want to lose someone, especially if they don't deserve it. Especially if, say, they got in a car accident, it wasn't their fault, and they don't have health insurance, and it was a hit and run, and they can't afford the medical bills, and they're going to go bankrupt, and they can't go to work because they work a labor job, like they're a waitress or a bartender, or they do manual labor, and they can't. I don't want this person to lose their house. We can work with them. Maybe you pay late. We put a payment plan in place. But the reality is, I have to be fair to everybody. And I can't play favorites. It's fair housing laws. There are fair housing laws in the United States of America. And what I do for one, I must do for all. And so we're happy to waive late fees, create payment plans, give you a little bit more time to rehouse a dog. But the truth of the matter is, like, there are some folks who it is their goal to break rules and do really stupid things. And sometimes you have to be harsh, and sometimes that results in some really tough conversations. And of course, everybody is the good guy in their own story. And everybody's going to look to the landlord. It's for that one person who wants to shoot up heroin outside their house. There's 50 more people in that community who are angry that I didn't get rid of that person fast enough. And then when that person's gone, they're still going to be angry that that even was allowed to exist in the first place. So in a lot of scenarios, it's lose-lose. It doesn't matter what you do. Inaction is bad. The correct action won't necessarily make people happy. And so it's a thankless job when bad things happen. And you just, you have to set your boundaries, and you have to listen and let people know that they are important to you. And you have to do your best to reinvest in your communities. To a point, some of the ideas and requests that folks have, or you just can't do it. You just can't, like, I can't just build a pool and not raise rent. I can't do that. Like, we have a budget. We got to do our best to stick to it so everybody can be happy at the end of the day. But you have to be firm but friendly. You have to have boundaries you can adhere to, and you have to have the courage to stay strong when somebody breaks XYZ rule.
Sounds like a very nuanced and crucial aspect of your business. You also discussed negotiating equity in early deals, advising that while starting small is acceptable, one should not remain in subpar structure indefinitely. What are your key insights on negotiating equity in early business deals, and how can you inspire entrepreneurs gradually push for better equity arranging over time while being both greedy and realistic?
When I started, I called over 1,000 people, and I can count on one hand the number of people who are willing to take a risk on me. And when you are in that position with no money, no network, no experience, you're in your 20s, you don't really have any negotiation leverage. You just don't. You have to take what you can get. And as you progress up the ranks, when you get more experience, when you have a bigger network, when you have a little bit of your own capital, you can start to command more. However, you have to realize that every investor you call is greedy, and they're not going to want to just, oh yeah, sure, I'll take less of an investment here. No, they want to make an outsized return as well. That's why they're going to give you money. And so what I have learned over the years is that when you look at human behavior, there are givers, takers, and matchers. A giver is someone who gives you something and does not expect anything in return. A taker is someone who takes something from you and does not expect to give you anything in return. And a matcher is someone who, if I give you one, you're going to give me one in return. Most people are matchers. So over 80% of the population, if they give you something, they expect something in return. But because you have offered someone a fair deal doesn't mean they're going to bend over backwards to make that deal. They're going to go, all right. When you walk up to a vending machine and you go, oh, look, there's a Gatorade, and Gatorade sounds good right now. I'm going to put $1 into the machine and get a Gatorade. No one's going to get excited about that. All right. If it was 10 cents for a Gatorade and you could buy 10 Gatorades for $1, all of a sudden you get excited as a matcher because you're going, what a great deal. And that's the type of mentality you have to have up front, is you have to make someone an inordinate amount of money. It has to be not fair in their favor. You have to make someone richer than they probably should be, and you have to take a slice of that pie in exchange. And it hurts when most people are matchers, and most people go, well, that's not fair. I'm not going to, sell a Gatorade for 10 cents when I paid $1 for it, right? Like, I'm taking a loss. I can't do that. When the reality is That's how you incentivize someone to take a chance on you. So then you have the opportunity to go create that track record and build the capital, build the network, have the experience. And every time you kind of graduate out of one of those levels, now you're a little bit more experienced, a little bit more capital, a little bit bigger network. Now, all of a sudden, the last, I don't know, 5 capital raises I have done, we've been oversubscribed. And what that means is we set out to raise X amount of money and we had more money show up than we needed. And we had to tell people no. And when you're at the point where you have the leverage that now folks are being turned away, what that does is, again, people want outsized returns, right? Well, if you tell people, and this is true, not that you're going to make this up, but if it is a true fact and you say, look, I only have room for X amount of investors here. All right, fine, we'll cut you in, but it's got to be way less than you want to put in and da 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 da. Folks get thrilled because you have now done something unfair to their advantage. So through whether you're, almost 100 deals in like I am or starting fresh or anywhere in between, you have to remember that your capital stack, debt and equity, mind you, they are looking at you and what you are doing as an opportunity to do something the rest of the marketplace can't provide. If you were a fair deal that you could just go to any old vending machine and put in $1 and get out a soda, then they're uninspired, right? Whatever, maybe we'll do this one, right? To get a line at your vending machine, you have to create the feeling that folks are getting an inordinate return because most people are matchers. So if they feel like they're getting more than they're putting in, that's when you start to win. And by the way, one really, really big way you can do that is when you finally have enough capital that you will put in at least 51% of the capital. That's one of the most powerful and compelling things to tell an investor is like, look, I am inviting you into this. I don't need your money. I've put up over half of the money myself. I am going to put an equity promote on my own money. So I'm going to haircut my own money. And when you say that and there's a waiting list, all of a sudden the whole world changes. So, the frustrating thing about today's, culture, if you will, is everybody wants something now. I want it now, 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 now. Folks lack patience. Folks lack the ability to be a giver because we're mostly matchers. And it's that psychological mindset shift that you have to master within yourself and commit to. Time and unfair deals favoring your capital partners. That is how you start to win. And while you may lose and get unfair deals, as it will feel like, not as it will actually be, but it will feel like you're losing and getting unfair deals up front, it will switch on a dime at some point, and now all of a sudden you will dominate. And that upfront investment of kind of unfair deals in favor of your capital partners, and that will switch and you will get yours, as they say in the United States of America, at some point in time when the time is right.
Finally, Ryan, if you are to offer one key piece of advice to an inspiring real estate entrepreneur looking to build a successful, resilient portfolio and make a positive impact, viewing growth as responsibility, what would that be?
People are going to hate to hear this. People are going to hate to hear this, but just don't quit. I know you've heard that a million times. I know it's a cliche and I know it's annoying to hear, but literally look at my last answer to your last question. It was in so many words saying that you have to commit years and years and years of your time. Well, the reality is you're going to invest a whole lot of time up front to learn, build your network, build your capital stack. It's not going to feel great for a long, many year period. For me, it was like 6 years, actually probably longer than that. And those 6 years were not as painful as they might sound. They were actually exhilarating. I had so much fun helping restore communities and helping investors get paid, and it was a win-win for about everyone involved. And that was an incredible part of my early years investing. But I was not a wealthy individual starting out. And I mean, you could probably argue I should be much wealthier than I am today, but I don't care because at the end of the day, I don't need a lot of money. I feel like I have enough money, knock on wood. But it all came from betting that if I play the long game, I will eventually win if I do all the right things. If I do the right practice, I learn the right skills and meet the right people. And if you are an investor listening, an early investor, you want to get into the game, you have to win the psychological battles. You have to. And the psychological battle is going to tell you, well, I don't want to invest in something that might not work out. Well, guess what? There's no guarantee your job is going to work out. I mean, how many times have people just gotten laid off out of nowhere? So you might as well pick something you really like and just commit. Lifestyle creep, that's a real thing. When you have a middle class job and it pays you a good salary and you have all these creature comforts that make you comfortable, it's hard to give those up, but those are never going to make you wealthy. And at the end of the day, the thing that will make you wealthy is winning the psychological battle in your head, is building skills, is building that network, is getting that experience. And that takes time. And if you quit every 6 months to go to the next shiny object, or even if you quit after a year or two because things just aren't happening for you, you have to start all over. And the hardest part about starting a business are the first couple of years. It is a disproportionate amount of hard work, pain, sacrifice, risk, and no money relative to what happens after it works. Then all of a sudden you're getting paid more than you think you deserve. So it flips. It's like you plateau, and then all of a sudden you go exponential. And it's that plateau that just feels like it lasts forever. And so many people quit before they hit that hockey stick growth. So I know it's frustrating to hear that cliche, just don't quit. There is literally no better advice that I could give your listeners than you've got to pick the right thing that you're passionate about, that can help people, that gives you fulfillment and excitement. And you have to just believe that it's going to work. And you have to be okay if you do it and it doesn't work. And you have to stick to it for years and years and years, because it's not going to come quick.
And this has been an incredibly insightful conversation. You have given our listeners a comprehensive understanding of building wealth through strategic real estate. Thank you for sharing your experience. Before we wrap up the official podcast segment, I want to ask you something that often comes up with our audience. For many real estate entrepreneurs, the biggest challenge isn't just knowing what strategies exist, but consistently executing on them, particularly when it comes to consistently acquiring new communities or attracting strategic capital to scale their operations without compromising their unique management philosophy. If you had a magic wand and could solve one persistent bottleneck for your business that's holding your growth or making it harder to consistently acquire those high quality communities and attract strategic capital, what would that one be?
To answer that in a very broad sense, the more I can automate, the better, because the robot, if you will, be it AI software, when it comes to low level, tedious, repetitive tasks, it's always going to be the human. Yes, it'll make mistakes, but maybe it'll make a mistake 1 in 100,000, whereas a human might make a mistake in 1 in 1,000 or 1 in 100. And it'll work at 2 a.m. It will not get sick or need time off. Human beings are amazing, obviously. But where human beings beat robots is when human beings can kind of bend the rules and get creative and just make magic face to face with someone and build relationships. Maybe robots will do that one day, but human beings are at their best when they're happy, when they're healthy, when they're well rested, and when they're doing something that gives them meaning and purpose that they're very good at. And so I don't say that I want more automation and more AI because I want to lay off my employees. Quite the opposite. I want to have more automation and more AI so my employees can do more of what they are good at that they want to do. I want them to be able to work how they want to, when they want to, where they want to, doing what they want to, because that's how you get the best out of someone. So to me, the biggest bottleneck in a very broad sense is anything that is tedious, repetitive, that prevents someone from doing what they're good at that they want to do. So to me, the more automations that we can have, the better. So I can get even more out of and have even happier employees.
Very clear focus. Can you expand a little on why automation is such a significant challenge for your business right now?
I wouldn't say it's a significant challenge. I would just say that's probably the best broad answer I can give. I heavily use automations for things like accounting, KPIs, even document review, as well as calculating things like late fees and scheduling correspondence with individuals. I use automations all the time and I am in love with it and I wish we had more of it. So I don't want to say that I'm lacking automation. It's everywhere in my business. I'm more saying I want more of it because it's absolutely a game changer. And it was up front for me with no money, not being able to hire someone when I needed to do a task 10,000 times in a day and it was only one of me. I could use a software to go and I write code to do something over and over and over and over and over again on my behalf. And maybe I take a day or two or three to write this code, and maybe I'm behind because I took all that time to write that code. But eventually I wrote that code, and now not only has the machine done it for me and flawlessly without issues, but now going forward for years, it does. There's coding I wrote years ago that is still working flawlessly to this day. And the amount of time I have saved is unbelievable. So I'm not saying that there's not a lot of automation in my industry. I'm saying I want more because it's fantastic.
Ryan, thank you again for such a valuable discussion. I know our listeners will get tremendous amount from this episode. Thank you. For our listeners, if you have not subscribed our YouTube channel yet, please press the subscribe button and you will get a lot of information from our YouTube channel. So now,
Thank you for having me. You too. Thanks again.
thanks a lot. Cheers.